Welcome to NTD Business. I'm Don Ma. U.S. stocks ended Wednesday little changed. This is, of course, after a Federal Reserve rate hike. More on that later. Following a long-awaited earnings Tuesday, big tech companies' shares had mixed reactions. Microsoft eased a bit despite beating estimates for quarterly revenue and profit. More on Microsoft in a bit. S&P 500 mostly unchanged. Nasdaq lost 15 points or 0.1%. The Dow Jones Industrial Average rose 89 points or 0.2%. Wells Fargo climbed after the bank's board authorized a new share buyback program of up to $30 billion. Now, Microsoft's earnings results signaled how much the high-stakes battle for AI supremacy will cost the tech giants. Microsoft's shares ended down 3.7% today as the company laid out an aggressive AI-related spending plan. The company said that deeper investments in AI are required before gains trickle to the bottom line. There's still a lot of excitement around AI, but we're still in the early stages of understanding what that means for the bottom line for companies. Wall Street's top regulator on Wednesday was poised to adopt new rules requiring publicly traded companies to disclose hacking incidents. And this is a measure officials said was being taken to help contend with the mounting cost and frequency of cyber attacks. If adopted according to the SEC, the cybersecurity rule would require companies to disclose a cyber breach within 4 days after determining it's serious enough to be material to investors. The rule would allow delays if the Justice Department deems them necessary to protect national security or police investigations. Companies will also have to describe periodically what efforts they're making to identify and manage threats in cyberspace. And both Democratic and Republican senators are expressing alarm over artificial intelligence. At a Senate hearing yesterday, experts in the field offered testimony on what the technology could be capable of. Here are the details.
A Senate Judiciary Subcommittee held a hearing on Tuesday about oversight for AI technology. Subcommittee Chairman Richard Blumenthal expressed alarm over the risks of the technology.
We're here now because AI is already having a significant impact on our economy, safety, and democracy. The dangers are not just extinction, but loss of jobs, one of potentially the worst nightmares that we have.
Dario Amodei is the CEO of AI company Anthropic. He said certain steps in bioweapons production involve knowledge that can't be found on Google or in textbooks and require a high level of expertise.
For a straightforward extrapolation of today's systems to those we expect to see in 2 to 3 years suggests a substantial risk that AI systems will be able to fill in all the missing pieces, enabling many more actors to carry out large-scale biological attacks. We believe this represents a grave threat to U.S. national security.
Computer science professor Stuart Russell of UC Berkeley has a different concern.
We can present to the system a great deal of information about an individual, everything they've ever written or published on Twitter or Facebook, their social media presence, their floor speeches, and train the system and ask it to generate a disinformation campaign, particularly for that person. And then we can do that for 1 million people before lunch.
Lawmakers from both parties expressed concerns over the technology. Senator Josh Hawley is ranking member of the subcommittee.
As AI develops, we've got to make sure that we have safeguards in place that will ensure this new technology is actually good for the American people. I'm confident it'll be good for the companies.
The hearing took place days after AI companies including OpenAI, Alphabet, and Meta Platforms made voluntary commitments to the White House. They agreed to implement measures such as watermarking AI-generated content to help make the technology safer.
ChatGPT creator OpenAI has pulled its artificial intelligence detection tool. This is less than 6 months after unveiling it. The tool had the potential to help teachers and other professionals to detect AI-generated work. OpenAI quietly shut down the tool last week, citing a low rate of accuracy. That's according to an update to the original company blog post announcing the feature. The company said it's now researching more effective techniques. The news may renew concerns of whether the companies behind a new crop of generative AI tools are equipped to build safeguards. And it comes as educators prepare for the first full school year with tools like ChatGPT publicly available. Well, this tool is shelved. There are still some alternatives on the market. Meanwhile, the most comprehensive survey of the global investment industry on central bank digital currencies to date has shown limited support for digital dollar, euro, yen, or pound. The survey is carried out by the CFA Institute. It's a worldwide association for bankers, investors, and finance chiefs. It found that only a mere 37% of respondents from developed markets said they favored a CBDC. By far, the biggest concern about CBDCs globally was the risk of cyber hacking at 69%. Data privacy was also a major concern for 64% of respondents in developed markets. Central bankers themselves have also raised questions about CBDCs, including Bank of England head Andrew Bailey. He said, "We have to be very clear to what problem we're trying to solve here before we get carried away by the technology." And Spotify, the popular music streaming app, is raising prices for the first time ever in the US. Why is this happening? And what can you do to save money? NTD's Faye Quarter explores some options.
For the first time ever, Spotify is raising its prices in the U.S. across the board, with increases ranging from 6 to 20%.
Most people have made the switch to streaming music services. And so they've established habits. So it's a little safer to raise prices because the habits have been formed.
Robbie Kellman-Baxter is the author of The Forever Transaction and The Membership Economy. Her own family has a Spotify family account as well as YouTube Premium. She says it would be very hard for even them to cancel at this point. There are additional reasons for the price hikes. Licensing fees are going up. Artists are demanding more. So streaming services are raising prices as well. The services also want to improve themselves, which requires more money. And finally, they want to make more money in general.
Spotify increased the price for the first time in 12 years since launching in 2011. And they increased the price by $1 per month, which is $12 per year. So I don't see that as a significant ask.
Mike Warner is the author of Work Hard, Playlist Hard, as well as an artist with music on Spotify. He says users will get a 2-month grace period to decide whether to cancel. There are some ways to save money despite the price increases.
If you like up-and-coming music, there are apps like SoundCloud and Bandcamp that are free. The other thing is, we have a family account that's six accounts for a single price. So if you're in a household with multiple people, considering bundling that together is another way to save costs.
Spotify is just the latest streaming service to raise prices. YouTube Music, Amazon Music, and Apple Music have all hiked their main plans from $9.99 to $10.99 a month over the past year. Faye Quarter, NTD News.
New home sales are dropping. They were down 2.5% in June compared to May. But sales for new construction is still up nearly 24% from a year ago. Buyers have been relying on those builds as an alternative to existing homes. That's because there just aren't many homes for sale. This slump could mean affordability is becoming more of a concern for prospective homeowners. Mortgage rates reached a high of nearly 7% at the beginning of June. South Korean electronics giant Samsung unveiled its latest generation of foldable smartphones today. The company's new device features a new zero-gap hinge and other updates. NTD's Andrew Thomas has the details.
Samsung presented its Flip 5 and Fold 5 in Seoul on Wednesday. According to Counterpoint Research, Samsung held nearly 2/3 of the foldable phone market in the first quarter of 2023.
The Flip is undoubtedly the story of this launch. It's a really beautiful product. Samsung is the market maker for foldables and they've taken it to the next level, but they've also had to do that because the competitive landscape has intensified as well.
Samsung says the new Flip 5 and Fold 5 screens are 25% more durable. They feature Snapdragon 8 Gen 2 processors specifically made for Samsung smartphones. The main improvement is a zero-gap hinge. The feature allows the smartphones to fold flat instead of the triangular shape of previous generations.
I think the overall compactness of these devices, although it's slightly marginal, and the weight reductions as well, just make them more comfortable in the hand, just make it a more refined experience, and certainly it means that it raises the competitive benchmark.
The Fold 5 is getting a slightly revamped multitasking app dock. Up to 4 of the most recently used apps automatically appear at the bottom of the screen.
They can see a real opportunity to try and seduce people away from iPhone, or at least keep them away from iPhone, with a new device with a new form factor with nice colors and a lovely user experience.
Counterpoint Research says global foldable phone shipments are expected to double in 2023 compared to 2022. Andrew Thomas, NTD News.
And finally, the Federal Reserve raised interest rates by 0.25 percentage point on Wednesday, the Fed citing still elevated inflation as a reason. The rate hike is the Fed's 11th in its last 12 meetings. The accompanying policy statement left the door open to another increase. Fed officials are estimating one more rate hike this year, according to their latest set of projections, but did not indicate whether rate cuts will be coming.
We'd be comfortable cutting rates when we're comfortable cutting rates, and that won't be this year, I don't think. It would be, many people wrote down rate cuts for next year. I think the median was several for next year, and that's just going to be a judgment that we have to make then, a full year from now, and it'll be about how confident we are that inflation is in fact coming down to our 2% goal.
Officials reiterated in their post-meeting statement that inflation remains elevated and that the Fed remains highly attentive to inflation risks. And now joining me to talk about this is David Hay, Co-Chief Investment Officer at Evergreen Gavekal. So, we just had Powell's speech. What's your first reactions? Let's start from there.
I thought it was a yawner, to be honest with you. Wasn't all that exciting. I mean, the market was very prime for a quarter, and he did that. I think maybe the part that's a little disappointing to the legions of bulls out there is that he's clearly keeping the possibility of future rate hikes on the table. And the market would love to hear that that's not going to happen, that we're finally at the end, and that the next moves are going to be down. And I think this is just another disappointment in that, although obviously it hasn't hurt financial market performance to have this just continuing tightening. And he did say very clearly, we are restrictive. And if anything, they're going to get more restrictive. And because he has been able to tighten as much as he has, with unemployment still staying at 3.6%, is really, frankly, remarkable.
Yeah, it seems like the market so far has, not too worried about the Fed anymore. They perhaps believe the Fed is at the end of its hiking cycle. I mean, what about Powell's language? How did that sound to you?
I think it sounded more confident and relieved than it has in a while. I mean, things have been going pretty good for him, and it's been a while since he could say that. And this latest inflation number was good, and growth is staying, fairly resilient. I don't think it's as resilient as a lot of people believe when you look at things like even grocery stores sales starting to disappoint, and even the high end. I mean, you can say, well, that's the low end, but at the high end with Louis Vuitton, LVMH, and Richemont having disappointing numbers in the U.S. And I think there's a fair amount of evidence that the economy isn't all that great, but it's certainly, if it's recessionary, it's early recession. I would argue that you do have already a profits recession. That's not an argument, that's a fact. Industrial recession, a little bit more of an argument, but not much. We've got the GDI, gross domestic income, in recession. Now we've got a government tax receipt recession. That's a lot of recession boxes that we could check off. So I personally think it's just a matter of time before these high interest rates do bite, and bite harder than they have already.
So recession is still on the horizon then?
In my book it is now, but to be fair and candid, I think it's not the consensus view. I think the consensus view is definitely shifted into either the soft or no landing camp. But I think that's ignoring history. We've had 15 months in a row now of declining leading economic indicators. They're called leading economic indicators because they lead. And yet people are blowing that off. They're blowing off the yield curve. What didn't get asked of Powell once again today is how come his favorite yield curve indicator, which is the 3-month versus the 18-month, which is deeply inverted, doesn't mean recession this time, whereas in the past he said that's 100% accurate. And you can say that about the yield curve overall. Whenever it's this deeply inverted, it has been 100% right.
Yeah, we do have to respect the lag effect. So you're saying we haven't seen the full impacts yet of interest rates in the 5.25, 5.50 range?
Absolutely not. I mean, it's been a very aggressive hiking campaign, but it's also been very quick. So a lot of this stuff really hasn't fully impacted, and there's something like half of all the private and public sector debt that's going to roll over in the next 2 years at 200 to 400 basis points higher rates. That's a big deal. You've already got a lot of floating rate corporate debt in America that's reset to the 10 to 12% range, and it was 5% not that long ago. So I think it's way too early for the the Goldilocks camp to be doing a victory dance.
Yeah, I want to continue this topic, but let me just ask one more question on Powell's speech today. Do you think it was a hawkish hike or a dovish hike?
Maybe mildly hawkish. Certainly wasn't dovish. And I don't think that the fact that he kept the door open for more rate hikes can be viewed as dovish. And it certainly, I mean, what really would have been dovish if he actually paused. But of course, the market was very primed. I think there were 97% probability it was going to hike. And the Fed doesn't like to disappoint, especially when it leaks things through its, the Fed whisper, Timorous from the Wall Street Journal. So they, they delivered what they said they would do. They didn't surprise. But I do think that there is this kind of constant disappointment that we're not to the end of the hiking cycle. But again, with the data staying relatively healthy, it gives them cover to continue to be restrictive.
So you're saying they're not done?
Possibly, but I do think that was one of the messages from today, is that the odds somewhat favor another rate hike. I think you'll see that as the handicapping starts to hit in the next couple of days, that that a September increase will be at least somewhere around a coin flip.
Okay, so let's continue this recession thread. Is this around 5%? Is that too restrictive for the U.S. economy? And mind you, the U.S. economy is very debt dependent. So it's like physics, right?
Yes, and it's very fair to say that the interest rate at 5.5% right now is very different than back in the 80s or 90s when debt levels were much lower. That is the challenge, is that we've been on a global debt binge for the last 20 years, and the tolerance for higher interest rates has clearly gone down. Though I think it's probably fair to say that most people, including myself, would have thought there would be more damage done. And for a while, it looked like it. I mean, we had a legitimate banking crisis on our hand just a few months ago, so it did look like they were breaking things. And of course, we had the worst year for balanced portfolios since 1871 last year. So we had a real bear market in bonds, we had a real bear market in stocks, but then everything's kind of calmed down, and we actually have a lot of indications that we're in an echo bubble with the performance of some of these ultra speculative stocks that it's almost like deja vu 2021 all over again. So and I don't think that makes the Fed very happy, is that, they've done all this tightening and yet you still got all this frothiness in the financial markets. So that's got to nag at them a bit.
Yeah, I mean, S&P 500 pretty deviated from moving averages, pretty overbought. What do you think has pushed back this recession? I mean, we were talking about one appearing last year in 2023. So where is it?
Well, again, it's not in the GDP, but ironically, if you remember back to the first 2 quarters of last year, we did have 2 consecutive declines in GDP, and a lot of people thought, oh, well, that is really a recession. And I wrote and said at the time, it doesn't seem that way. Did not feel like a recession in the first half of last year. Interestingly, gross domestic income, which a lot of brilliant people like David Rosenberg think is more reliable than GDP, did not confirm it last year, but it now is, as I said earlier, in recession. So you've got a profits recession. That should matter to the stock market, right? That's what really they care about, is what are profits doing. We've had almost certainly 3 down quarters in a row. We do have an industrial recession, or certainly a cardboard box recession, as Schwab's Jeff Kleintop calls it. And that matters because it's consumer goods and industrial goods that get shipped in cardboard boxes. And the trucking industry is in a total tailspin. So, and then now you've got U.S. government tax receipts down significantly at over a 20% rate in the last 3 months. So there's a lot of recession straws in the wind.
Yeah, I mean, do you think the Fed has over-tightened then?
Probably, but we won't know. I mean, that's their history, is that they raise and they raise and they raise, and they don't get the immediate effect that they think they'll get. So then they keep tightening, and then at some point something goes wrong. You have that Wile E. Coyote moment where it goes off the cliff. And then they realize, oh, now we've got to start cutting. And then they cut very quickly, very aggressively. But we're clearly not to that point. I mean, the economy, to me, looks in the early stages of a recession, but not in a recession. So they're probably not going to do anything until they see. I mean, I think it's going to take a significant increase in the unemployment rate to really cause the Fed to reverse and start cutting rate. And they've got, unlike in the past, and this is the highest we've had the Fed funds rate in 22 years. So they've got a lot of room to cut, which is different than when we're going into COVID. They really didn't have that much room on the downside. So we could see interest rates come down 300, 400 basis points once they do start to panic.
Yeah, I mean, markets are definitely hoping for a Fed cut. But as you mentioned now, if the economy is doing well, I mean, why would the Fed cut rates? What do you think of this dynamic here? Is the market wrong?
Oh, yeah. I think that the expectation that they're going to cut under the current circumstances is wrong. And I felt that way, and it's been that way, and I think it's going to continue to be that way. There's got to be much more pain felt than what's been incurred so far for them to actually do that. So that's the downside of, and if you look historically, this is kind of an interesting factoid, the 2-year T-note has always gone above the Fed funds rate. And right now it's well below it. So that would mean the 2-year, if history is going to play out, and maybe it won't, I mean, this time could be different. These are certainly very unusual circumstances. We've never had, a COVID kind of thing. We've never had the kind of fiscal and monetary response that we had in the wake of COVID. So a lot of stuff is different this time, I would admit. But that would imply we could see the 2-year T-note go to close to 6%. That would be, I think, disturbing to the market. I just think there's an awful lot of complacency out there right now because prices have been rising. That tends to feed on itself. But, that momentum is a two-edged sword. If it turns and goes, south, it could have a very pronounced effect with people so kind of, fat, dumb, and happy right now.
And let me get your thoughts on this too. So the Fed is tightening, but the fiscal policy is doing the opposite to an extent. I mean, just give me your thoughts on that.
Oh, you're totally right. Is that we have a budget blowout again, and we're probably looking at about a $2 trillion deficit, which is frankly shocking. I mean, you're talking about something that's around 7 to 8% of GDP. And that's one of my arguments about, is this economy really that great when you look at nominal GDP growth? So real growth plus inflation around 6%, you take away that government deficit spending and you've got negative private sector growth. And that is not an inherently healthy economy, and I don't think it's sustainable. And one of my biggest fears is we're going to have a major hiccup in the Treasury bond market in the second half of this year just because of this tsunami of supply that's coming.
So your worry is that there won't be enough people to purchase Treasury securities?
Exactly, because for one thing, just the Fed alone, the Fed for so many years was in QE mode, quantitative easing, where they were buying treasuries, trillions of treasuries, and now they're actually selling at a rate of close to $1 trillion per year. And they had to reverse that during the banking crisis of the spring, but now they've resumed it. Foreign central banks are not buyers; they're actually net sellers, especially the big ones, Japan and China. The U.S. banking system they're basically broke, or at least a lot of the banks are broke if you really mark their securities portfolio to market. So they've got way too many treasuries on their balance sheet. And individuals, absolutely, but individuals have got a lot of duration. Apparently the duration levels are about a 20-year high. I think where individual investors are going to be skewing more of their purchasing is to the short end of the curve. You get those T-bills that are yielding 5.5%. I think the 10-year at a 3.80, something like that, I don't think that's that attractive to the average investor. I think they are suspicious that return will get inflated away. And I think they have every right to be cynical that will be a true interest rate.
So the U.S. is pretty leveraged, but my opinion on debt is it's not a problem until confidence drops. So are we going to see that happen with the U.S. debt? Are people going to lose confidence in that? I mean, what's the catalyst going to be?
Well, a catalyst could be a really sloppy Treasury auction, which is, I think, a distinct possibility given how much supply is coming and how, I just went through kind of this restriction of the normal buying pool. So you could really have a demand-supply mismatch that could trigger a spike in yields. I think eventually we're going to have to uninvert the yield curve. It's not going to stay this way indefinitely. And by the way, when the yield curve uninverts is when you really have to watch out. That's when trouble usually hits. The same thing, once the Fed starts cutting rates, that's when you really have to start to be on guard for a recession or a more serious or second bear market. So it's it's not a great situation when that happens, but I do think that we will see dramatically lower short-term interest rates at some point, but it could be accompanied by a rise in longer-term rates because of this buyer's strike, if you will, given the U.S. government's horrible fiscal condition. And we just act like we have the world's reserve currency so we can, basically operate with what used to be Banana Republic monetary and fiscal policy, and not monetary now. Monetary was very loose during COVID, but as you point out, we've got these two going different directions right now. So we have this extremely irresponsible fiscal policy and then Powell leaning the other way. And I think that's going to be a collision at some point.
Do you think this situation can be fixed, or has the ship sailed?
Well, it can always be fixed. I think we're going to have to make some very hard choices eventually. And I do think we're going to have a currency that's backed more by real assets, whether it's gold or maybe some basket of commodities. But I think that there's a trend going on to de-dollarize the global economy, and it's tough because we're entrenched. But you can see almost every day there's another announcement about a set of countries that are going to trade in something other than U.S. dollars. That kind of pervasiveness we have never seen before. So there's kind of the early stirrings that the market is rejecting the U.S. government's policies. And I think where you're really going to see that stress hit first is the long-term treasury market. I think the long-term treasury market is more at risk than the U.S. dollar because, frankly, the U.S. dollar is competing against currencies like the yen and the euro, and they've got their own problems. But when it comes to, the treasury bond market, that's one that could really fall out of bed, even if the reserve currency status is maintained.
I think one obstacle standing in front of the solution is politics. Sometimes people don't want politicians to do the right thing. Sometimes when politicians do the right thing, they don't get reelected.
Well, that's precisely right, and that's what we've seen, kind of on a escalating basis for the last 20 years, is the politicians are becoming more and more willing to buy votes with spending policies that are completely unsustainable. But you're right, and a lot of times, I'll be out of office by the time that bill comes due, and we've had way too much of that mindset for the last 20 years. And, it's just hard to believe that in the late 90s, early 2000s, we were running surpluses, and Alan Greenspan worried before Congress that we would not have a treasury bond market by 2010 because we would have paid off all the debt. And that turned out to be another, terrible forecast by a Fed official, senior Fed official. But and by the way, the Fed has never called one recession in its history. So when I say it's had a terrible track record, it really has. So you're exactly right, and we're paying the price for that now. And I think there's going to have to be the problem is the biggest problem by far is the entitlements, which have been allowed to fester, for decades. And now that bill is starting to come due because those liabilities are no longer future; they're present. So you've got an explosion in Medicare spending, an explosion in Social Security spending, and there's just obviously military spending is going up because we've got a world that's at least in some form of war footing, and there's just this belief that the federal government can continue to finance itself indefinitely with borrowed money, and yet the pool of borrowers has shrunk dramatically. So that's why I think that's coming to a flashpoint soon.
All right, just one last question. If you had to take a guess, when would you put the recession occurring?
I would say probably sometime fourth quarter of this year, first quarter of next year. But I would say I keep pushing that back. I would have thought we would be in recession by now. But as I said, in a lot of ways we already are. But as far as an official recession, you never know because they backdated, so it could be right now. But I think relatively soon.
All right. Thank you so much today, David. It was great hearing your
insight. Thank you, Don. Thanks for having me on.